Hello, guys. Welcome back again to the Tyro Trader YouTube channel. This is a continuation of a series of how to start out in the Forex market. So, we are going to talk or expand on the things we talked about in the previous video. And in this video, we'll talk about spreads, we'll talk about pips, we'll talk about candlesticks on a basic level. We'll talk about bid and ask, buy and sell. We'll talk about the bull market. We'll talk about the bear market. We'll talk about currency pairing. We'll talk about the basics of what you see on the screen at the moment. We'll also talk about brokers and how to hook up a broker to your TradingView platform. There are a couple of other platforms you can use. Most definitely, you have the MetaTrader 5. But what we will be doing actually is to focus on TradingView because you pretty much can get everything you are looking for in TradingView. You can mark up your charts. You can do almost everything on TradingView. So we'll just get into it. So in the previous video, we talked about foreign exchange, we talked about currency pairing, and I'd like to start from there. So we are actually going to talk about something before we go ahead into the video properly, and that's called contract for differences. Everything you see on the screen at the moment, contract for differences. And what is a contract for difference or contract for differences? I'm actually not going to define it because you can, easily Google what contract for differences is, and get yourself an explanation. But I'll just like to break it down in a layman, explanation. And it is simply when you buy something, but you don't actually own the underlying asset. So all you see on the screen, for instance, you have gold spot and US dollar. Let's assume you decide to buy gold. This gold you're buying is actually not going to be shipped to your house. So what you're doing actually is paying a penny, for instance, to get a portion of gold, or say an ounce of gold, for instance. Once you get this ounce of gold, you leave it for say about 1 or 2 months, and you decide to sell back the gold. The difference between when you got the gold and when you're selling it is what you get as your profit or your loss. So that's the same thing. That's the same thing that goes for everything you see on here. On the other hand, say you go to a bureau de change or bureau de change to actually get yourself a currency. You have dollars with you and you want to buy naira, for instance, or you want to buy British pounds. That is, getting the actual physical currency. But on foreign exchange that you trade online, you're actually trading CFDs. So that's what is called CFD, certificate for differences, and you are actually not owning the underlying asset. So once that sinks in, you can understand, things like the use of leverage to amplify your trading, which could also be dangerous. All those things are going to be talked about in videos to come. But just to put out that common knowledge or that knowledge about what we're doing, this is CFD trading, which is contract for differences. And when you choose to buy or sell an asset, you buy and you don't actually own the underlying asset. When you decide to sell, the difference between when you bought and when you sell is your actual profit or loss. So what actually happens in the foreign exchange market is this. You have a currency pair, just like you see here. You have gold, which is a commodity, versus US dollar. You have the Australian dollar and the Canadian dollar. You have the British pound versus the US dollar. And just to, break them down, or I'll just leave them this way so we can see the description. You have the Canadian dollar, versus the Japanese yen, which is the chart you are seeing right in front of you. What happens in the trading market is you either buy or sell. And, it's usually said that you buy low and then you sell high. So you're, pretty much doing two things. One is either you're buying, two is either you're selling. What circumstances you buy or how or what you buy depends on your buyers in the market, what you think, what currency you think is going to appreciate, and what currency you think is going to depreciate. But all those are going to be get into in later videos. Right now we want to see what happens when you buy and sell. So this is a chart. I'll just draw this here so you can see this clearly. So now this is it. This is a chart, the Canadian dollar versus the Japanese yen. What happens when you buy? So let's say you decide to buy. This is buy, this is sell. Let's say you decide to buy. What you do at every point in time when you buy is you buy the Canadian dollar and then you are exchanging it for the Japanese yen. You would ask me, okay, my account is in US dollar or British pounds, for instance, or say Nigerian naira. What happens at every time when you want to buy on this chart, for instance, is whatever your account is, whatever currency your account is domiciled in, is converted into Japanese yen. Let's say you're buying. Your currency is converted into Japanese yen, and then you are selling Japanese yen to buy Canadian dollar. Just so you know, at every point in time when you buy the Canadian dollar, there's someone exchanging the Japanese yen to net your order. So, on the other hand, if you decide to sell the Canadian dollar, you are buying Japanese yen. If you buy on this chart, you're buying Canadian dollar and selling Japanese yen. If you're selling the Canadian dollar, you are buying the Japanese yen. So that is exactly how it works with this pairing. For whatever currency your account is domiciled in is insignificant to whatever it is you want to buy or sell on your account, because there are a lot of conversions actually happening when you trade different currencies. So that's what happens at every point in time when you buy. So let's assume that at the break of this trend line, you decided to buy the Canadian dollar. That means you are actually selling the Japanese yen to hold a portion of Canadian dollar. At this point, let's say you decide to sell the Canadian dollar that you held from here, it means you're selling the Canadian dollar and you're going to be in possession of Japanese yen. So that is how the buying and selling goes. And on this chart, you can see it is actually in an uptrend, which is something we'll talk about later. At every point in time when you see this going up, it means the Canadian dollar actually is gaining strength. So it goes up, it tells me the Canadian dollar is gaining strength. It comes to a point of consolidation. It tells me the Canadian dollar is, resting. And then it keeps going up. It tells me the Canadian dollar is still strong. So the ask price and the bid price are actually something significant. And in between the ask price and the bid price, you have a gap called spread, or a spread which is calculated in pips, which is something we'll still talk about in this video. The ask price is the price at which you can buy the base currency actually. So at every point in time when you see the ask price, which is the blue line, that is the price at which you can buy the base currency, while the bid price is the price at which you can sell the base currency. The spread is actually calculated in pips and is done by each broker, different brokers and different spreads. And this is actually a way for brokers to make their money. Pips, price movements, are calculated in percentages or points. I'm going to show you what points are on Japanese yen pairs and other foreign exchange pairs like the Euro USD or the Australian Canadian dollar. For every point in the market or for every movement in the market, it is actually calculated in pips or percentages. So pips are called, percentages in points or price interest points. So I'm going to draw this to the side and show you from here. And then we'll still come back here so you can see what I'm talking about. So for some brokers, you have currency pairs basic currency pairs like CAD, CHF, or British pounds, USD, they usually have 4 decimals after the point, and the last digit is the pip. So for the British pounds and US dollar, this 7 is actually the pip. At the point that this price moves, or this rate moves from 1.216 from 7 to 8, you have 1 pip. So at the point where you get this 1.1268 move to 1.170, for instance, you've gotten 2 pips from 67 to 70. You've gotten 3 pips. Some brokers express this number in 5 numbers after the decimal point, which is what you see here. And this little number here is called pipet, which is 0.4 at the moment, 0.7 pipet, which is not up to a pip. So at the point where that gets to 10 or 0, you get a complete pip, and this number changes to 8. Now, Japanese yen pairs, you're supposed to have 2. The standard is to have 2, which is still the same thing. Like I said, this last number is what is represented as a pip. At every point in time when this changes, you get a pip. From 2 to 3, you get 1 pip. From 2 to 5, you get 3 pips. From 3 to 20, from 13 to 20, you get 7 pips. While this is a pipet, which is 0.9 pipet at the moment, 0.1 pipet at the moment, and it's like, seconds, which leads to a minute. So, and I'll also show you here on the chart actually. So you can see 104.118. This is a Japanese yen pair, which should be 2. So you got, 1.31. The 1 is the pipet, while the 4 is the actual pip. So we're just going to look at this for like say 30 seconds. We have 104.13, and we'll see where it goes in 30 seconds. So you can see in 30 seconds we've moved down from 1.3 to 1. We've moved down from 1.0413 to 1.0409, which means we've moved down 4 pips. We've moved down 4 pips. That is how you express your profit. How many pips can you catch on a daily basis? How many pips can you catch on a weekly basis? Many professionals talk about percentages, not, I made $200 or I made $100. Many professionals talk in pips. Many professionals talk in percentages. Oh, the US dollar moved 20%. Oh, the US dollar moved 0.5% yesterday. So that's that for what a pip is. That's all for this video. I'll let you soak in what we've talked about, and I'll see you in the next video. Bye.